Hey everyone, welcome back to Corporate Decoder. Today we're diving deep into Beneficient latest 10K filing, and let's just say this one has more twists and turns than a financial thriller movie. Seriously, get ready for some roller coaster numbers and some eyebrow-raising legal drama. Before we jump in, if you love getting these complex filings broken down into plain English, smash that subscribe button and ring the bell so you don't miss a single episode. And hey, we've got a fantastic community discussing these reports over on our Discord, link in the description below, so come join the conversation. Alright, let us decode Beneficient 2025 annual report for the year ending the 31st of March. This is a company that is clearly navigating some choppy waters, and their latest filing paints a picture that is, well, let us just say interesting. Looking at their financial condition as of the 31st of March 2025, we see a company with just over $1.3 million in cash and cash equivalents. Now, that might sound like a lot, but when we consider their liabilities, things get a bit tighter. Their total liabilities are sitting at almost $300 million, and what is really catching my eye is their debt due to related parties, which is a whopping $117.9 million. That is a huge chunk of change, and it tells us a lot about who the company is borrowing from, and it hints at some complex relationships we'll touch on later. Their total assets are $354.9 million, but here is the kicker. Their total equity is a negative $34.9 million. Negative equity means the company owes more than it owns. That is a big flashing red light for any investor. Now let's look at how they performed financially. For the year ended the 31st of March 2025, their total revenues were a negative $7.9 million. Yes, you heard that right. Negative revenue. This is largely due to a significant loss on financial instruments and investment losses. Their total expenses were over $16 million. This resulted in an operating loss of $24.2 million. This section clearly shows the company is struggling to generate positive income from its core operations. Diving into their Ben liquidity segment, which is supposed to be their main business generating interest income, we see that interest income decreased from $46.9 million in 2024 to $42.6 million in 2025. While their provision for credit losses also decreased significantly, it is still a substantial amount. What is really concerning here is about 50% of their loans are non-performing. That means half of the money they've loaned out isn't being paid back as expected. Imagine loaning money and knowing that half of it is probably not coming back. That is a tough business to be in. In Ben custody, their trust services and administration revenues actually saw a slight decrease from $24.5 million to $21.6 million. While their operating income is positive, it is dwarfed by the massive goodwill impairment charges they took in the prior year, which were over $500 million. Looking at the customer Exalt Trust segment, which represents their investments, we see a big drop in investment income, going from a positive $4.8 million to a loss of $6.5 million. This highlights the volatility in their investments. It seems the value of the alternative assets they hold has taken a hit, impacting their overall performance. Now, this next number is a doozy. In the year ended the 31st of March 2024, Beneficient recorded a staggering $2.4 billion loss on impairment of goodwill. Let that sink in. They essentially wrote off $2.4 billion because the value of that intangible asset, goodwill, had plummeted. For the year ended the 31st of March 2025, this number dropped to $3.7 million, which is still significant, but shows a massive decrease in the goodwill impairment. This massive write-down in the prior year is a clear sign that something went very wrong with their previous strategy or acquisitions. And then there is this line item, an accrual or release of a loss contingency related to an arbitration award. In 2024, they accrued $55 million for an arbitration award against them. But in 2025, this was released, meaning the court overturned the award. It is good news they avoided that massive payout, but the fact that this even made it to an award and then to court is a red flag regarding their legal and internal processes. When we look at the bottom line, net income attributable to common shareholders for 2025 is a positive $51.2 million. That sounds great, right? But then you look at 2024 and it is a negative $2.1 billion. This massive swing is mostly due to that goodwill impairment charge. The net income in 2025 is largely a result of releasing that arbitration loss contingency. So, while it looks like a profit, it is important to understand the drivers behind it. It is not necessarily from growth, but from reversing a bad situation. Let's talk about their core lending business. As of the 31st of March, 2025, their net loans to customer Exalt trusts were $244 million. But here is the worrying part: their allowance for credit losses, which is money they set aside for loans they expect not to get back, is a huge $342 million. They set aside more money for potential losses than the actual loans they have on the books, and get this, their non-performing loans, meaning loans that are way past due, make up a massive 50% of their total loan portfolio. That's a staggering number and a major concern for the health of their lending operations. Their provision for credit losses also highlights this issue, showing a decrease to $1 million in 2025 from $6 million in 2024. While the decrease is good, the fact that it is still a notable expense coupled with the high non-performing loan ratio underscores the credit risk they're refacing. Let us look at their investments held by the Customer Exalt Trusts. These are valued at $291 million. These are their collateral backing the loans. The vintage of these funds ranges from 1993 all the way to 2024, showing a very long-term investment horizon. However, the fact that 50% of their loans are non-performing highlights that the value of this collateral is a serious concern, and that their due diligence might not be as robust as they claim. Now, looking beyond the financials, Beneficient is facing some serious headwinds. They mention the possibility of future goodwill impairment. This means that even after those massive write-downs, the value of their intangible assets, like goodwill, might still be too high. If their stock price continues to fall, they might have to write off even more, further impacting their already negative equity. And then there is Nasdaq. They've received multiple notices about failing to meet listing requirements. This includes issues with their stock price staying above $1 and filing their reports on time. While they've been granted extensions now and then, the continuous struggle to meet these basic listing rules is a big red flag. If they get delisted, it would severely impact their ability to raise capital and could crush their stock price even further. Perhaps one of the most concerning disclosures is about their debt. They have significant debt from related parties, including HCLP and HHBDH. In fact, they received a notice of events of default from HCLP in July 2025 on a loan approaching $100 million. Even more alarming, they're reinvestigating evidence that their former CEO might have been involved in fabricating documents related to this very loan. This is just a business risk. It is a potential fraud issue that could unravel a massive portion of their assets. The fact that this debt is collateralized by all the assets of their subsidiary BCH is a massive exposure. Adding to the legal drama, they've been involved in a terminated SEC investigation. While the SE staff decided not to recommend enforcement actions, the fact that they received a Wells notice shows how seriously regulators were looking into their past dealings, particularly those related to GWG Holdings. This, along with ongoing lawsuits from the GWG Litigation Trust and the Paul Capital Advisors case, paints a picture of a company deeply enmeshed in legal battles. The report explicitly states, "Our current inability to raise sufficient capital, recurring losses from operations, negative cash flows from operations, and delays in executing our business plans raise substantial doubt regarding our ability to continue as a going concern." This is a direct warning that the company might not survive without significant new funding. It is a stark statement that underscores the precarious financial position they're in. Unsurprisingly, there have been significant leadership changes. Thomas O. Hicks was elected chairman of the board, and James G. Silk is the interim CEO, taking over after Brad Kay. Heppner resigned from both CEO and chairman roles in June 2025. The filing hints at serious allegations regarding Mr. Heppner's conduct related to the HCLP loan and fake documents, which definitely adds to the company's legal and reputational challenges. So, what is the verdict on Beneficient? On the surface, they have an innovative business model addressing a real need for liquidity in the alternative asset market, and their AltAccess platform sounds technologically advanced. However, the sheer volume of risks, the massive goodwill impairment, the negative equity, the alarmingly high number of non-performing loans, and the ongoing serious legal troubles, especially concerning that HCLP loan and former leadership, are deeply concerning. The company is painting a picture of attempting to get its house in order, evidenced by cost-cutting and the leadership changes, but the fundamental financial health and the unresolved legal clouds cast a very large shadow. Their ability to continue as a going concern is explicitly in doubt, meaning there is a real risk investors could lose everything. It feels like they're trying to build a skyscraper on a shaky foundation. That is our deep dive into Beneficient's latest filing. What are your thoughts on their situation? Are they on the path to recovery, or is this a case of too little too late? Let me know in the comments down below. If you found this breakdown helpful, please give it a thumbs up, subscribe for more corporate dissections, and definitely join our Discord community through the link in the description to keep the conversation going. Thanks for watching, and we'll see you in the next video.